discretionary spend in the US, and that's reflected in the names of IT majors. While just on the positive side, we've seen Nifty financial services and pharma end higher for the second consecutive day. Apart from that, I think we are flashing the IIP data. The CPI data is also out. And overall, in the US, we expected the CPI data as well as the crude oil inventories to come in post-market hours and have an effect on Indian markets tomorrow as well.
Absolutely, Puneet. Thank you so much for providing us that perspective and all the information on the benchmark indices extending these losses. Let's move on now, because we're also seeing that February data, the Indian mutual fund industry experienced a notable shift in investor behavior as reflected in the latest data from the Association of Mutual Funds in India. We saw net equity inflows decreasing by 26%, while inflows into small cap funds dropped by 35% and mid cap funds saw a 34% decline. My colleague Neeraj Shah now joining us to detail out how the market has influenced investor behavior with a focus on safer and more specialized investments.
Well, the monthly inflows of February, there are 2-3 ways to look at it. Now, if you look at the SIP flows, let me start with that. There is a 400 odd crore reduction. Now that, to my mind, is explained by the fact that month on month, that is explained by the fact that February is 28 days, Jan is 31. So that explains SIP flows. So SIPs have stayed true to nature. What has gone down, most importantly, so the active equity funds have seen net inflow dip to 29,303 crores versus inflows of 39,688 crores month on month. A lot of it is explained by mid-cap and small-cap funds. Mid-cap funds have seen net inflow go down to 3,400 crores versus 5,148 crores. Small-cap funds have seen net inflows go down to 3,722 crores versus inflows of 5,721 crores. So nearly 2,000 crores gone in small-cap funds and nearly 1,800 crores or 1,700 crores gone in mid-cap funds. Large caps are okay. 2,866 crores versus inflows of 3,063 crores. Flexi-cap funds are okay, about 500 crores lower. Mid-caps and small-caps have seen a large dip. Sectoral and thematic funds, not a bad thing actually to happen, have come down to 5,712 crores versus inflows of 9,017 crores. And NFO flows are down as well. So effectively, the scare in the markets, remember, 1 year of very low returns or no returns in certain cases, and certain fund managers going out and saying that SIP flow should be removed, done away with. I think that is probably what has led to this. Now the key question is, does this continue in March, wherein March is stable, or does March continue to see a downtick in inflows? One hopes that that doesn't happen in a big way, except for certain pockets where it might be prudent to do so. So sectoral funds, for example. But I think March is a litmus test. Why I say this before I end, why I say this is because even in the Macquarie feedback from European Union investors, Macquarie was told that global investors are watching out for what the Indian domestic retail investor does in mutual funds. So I think it's a very important barometer to keep in mind.
Absolutely, Neeraj. Thank you so much for that insight. In fact, we even spoke to Anand Vardarajan, Chief Business Head of Tata Mutual Funds, where he shed light on the factors that were driving the decline in equity net flows and discussed how this trend might shape future investor sentiment. Let's listen into that.
You'll have to count 3 days lower. Jan had 31 days, so to that extent, I think that explains the dip. And in a full-blown month, I think your number should have been somewhat similar. In as far as the dip in equity numbers are concerned, I think, Neeraj, if you were to look at it, I think February was the first month where even your large cap 1 year returns had become flat, as flat can be. And to my mind, that could have had some sentiment impact, because your mid and small cap 1 year returns had turned negative sometime end of Jan, early Feb. But I think the last straw to my mind would have been, large cap or Nifty returns being flat to slightly negative. And that could have had some recency, impact as far as investor sentiment is concerned.
And the news that we all have been expecting and waiting, retail inflation outlook for February 2025 has just come in, and we've seen that it has eased to 3.61 in February. Let's remember it was 4.3% in January, which was the lowest in 5 months. Let me quickly go across to my colleague Pallavi now, who's joining me in the studio to tell us more about the data. Pallavi, over to you.
Right. So, like you mentioned, the headline figure has come in at 3.61%. This is, in fact, even better than was being expected. We were expecting some de-acceleration in inflation, but we were expecting the figure to come in at about 4% or just a tad below that. It's actually come in even better at 3.61%. This is the lowest we've seen in 7 months, and this continues to be led by the de-acceleration in food and beverages, and most notably vegetable inflation, which was which had been deaccelerating but was still at almost double-digit growth up until the last print, is now seeing a contraction of 1.1% for the month of February on an annual basis. So that's vegetables. Food and beverage inflation has come in at 3.84%. Let's also have a quick look at some of the key internals. Pulses, vegetables and egg saw de-acceleration in the food categories. In case of pulses, it was at minus 0.35% for the month of February. Clothing and footwear inflation came in at about 2.68%. Housing was at about 2.9%. Fuel and light continued to remain in contraction and came in at minus 1.33%. For more details and on how first take on today's figures, we're going to be speaking to Yuvika Singhal from Quant Eco Research. Yuvika, hi. Thank you so much for taking time out to speak to us.
Hi, Pallavi.
So,
my pleasure.
Yeah, tell me, what are you making of today's print? Both IIP and CPI seem to have surprised in terms of what the expectations were and the prints we've seen.
Yes, absolutely. I think to begin with, CPI is definitely a very comforting number. Like you said, it surprised us sizably on the downside with the market consensus and our own estimate, somewhere expecting the number a tad shy of 4%, but it's come in at 3.61, and that's almost 30 basis points lower. So definitely a good CPI number. So while we did see CPI correcting over the last 4 months, and as we all were expecting, largely vegetables were expected to play an outsized role in this deacceleration that we've seen. I think that's largely the story that has happened in the month of Feb, that vegetable prices continued to contract for the 4th consecutive month, probably at a pace that did outsee or did outdo most of our expectations. So that's definitely good news, because if you would remember the whole spike in inflation prior to the months of November, especially during last year, June, July, August months, was largely led by vegetable prices. And this correction, which has come in fairly swiftly and over the last 4 months, thanks to the winter seasonality kicking in a very meaningful way, has offered comfort not just to food prices, but also to headline inflation at the end of the day. So it also displays, in some sense, the volatility that vegetable prices impart to the headline CPI print, not just taking the headline print higher, but also when there is a correction, it tends to come in very swiftly. And this is largely in line with the market expectations that the Feb print was expected to slip in below 4%. So I think that's definitely good news. As far as IIP is concerned, I think that number also surprised us positively, closer to 5%. Market was, again, somewhat lower in the range of 3 and 4% broadly. This is somewhat surprising, largely because Feb does see lesser number of working days. And if the number has shown a positive month-on-month and a YOY, that definitely indicates that there was stronger momentum as far as economic activity is concerned in the month of February. And this ties up well to the overall picture that we expect Q4 to see a better growth momentum. Q3 did see a recovery, but Q4 is likely to see galvanization of this momentum. While most of the lead indicators so far were painting somewhat a mixed picture, this IIP will go much ahead to cement that view that Q4 is likely to see a growth outcome that is way better than Q3, largely because of economic activity picking up in the manufacturing manufacturing sector. There's likely to be a backloaded push from government capex, and not to forget the localized impact of Mahakumbh, which could have given some extra push to consumption in Q4. So I think because of these factors, we could see Q4 doing a tad better, and I think the IIP number validates that.
Okay, so I do want to understand, in case of inflation, what is the expected trajectory going forward in case of your estimates? What are your estimates looking like? And can we also see some change possibly in the RBI's projections? Also added to that, today's figures pretty much cement the next rate cut as well. Would you say so?
So as far as the trajectory is concerned, I think early days yet, but we have data for about 10, 11 days of March. And it does seem that the CPI reading as of now is tracking close to 4%. So we are likely to see some reversal in momentum in the month of March, and that's likely to come in on the back of vegetable prices moving up. Now, remember, up till Feb, we did enjoy the winter seasonality, but last month was one of the hottest Februaries that we've seen in over a century, and we do not expect March to be any different. And with temperatures soaring, it is likely to pull up perishable prices, especially vegetables. So by the time we close the month of March, it is likely that the comfort that we have enjoyed on vegetable prices in the last 4 months is likely to wane off completely. Also remember, the month of March has already seen upward revision to milk prices with the early onset of summer. While we don't have concrete evidence yet, but there could be some negative impact on the wheat standing crop because of excessive high temperatures that we are witnessing across the country, especially in the northern part of the country. So we'll have to wait and see how March pans out, but it does seem that inflation could move in higher. Like I said, it's currently tracking slightly above 4%, and this number could probably cement close to 4.1, 4.2. We'll have to wait and watch and see. Having said so, while we do expect food prices to harden here on, we still do not see them becoming a red flag. In fact, the comfort that we have enjoyed on food prices is likely to continue into FY26. And this is largely to come, Pallavi, on the back of the last 1 year performance of the agriculture sector. So remember, we have seen a bumper Kharif output last year, followed by a fairly reasonably healthy Rabi output that is expected. The sowing for the summer crop, which is a very short period between March and May, has also begun in a meaningful way, and there is no adverse impact of higher temperatures so far that is being seen. So what this would ultimately mean is that the gradual decline that we've seen in food prices should continue despite the summer seasonality kicking in, and that is seasonality. So YY numbers will probably not get impacted to a much larger extent as far as seasonal summer prices are concerned. So we should continue to see the gradual decline in food prices continuing into FY26. I think the biggest joker in the pack will be what eventually happens on monsoon. While again, early days yet, but global phenomena, global agencies tell us that and so conditions are likely to move towards neutrality by the time we are in the peak summer months. So that would mean neither an El Nino nor an El Nina, so somewhat neutral for Indian southwest monsoon. But there are also private agencies who have put out initial forecasts saying that the monsoon this year is or could be above normal. If that does transpire, I think that would cement our views of a gradual deceleration in a much more meaningful way, since most of our assumptions are based on a normal monsoon outcome next year. But if that was to surprise negatively, if monsoon was not up to the mark, or there are distribution unevenness in the monsoon performance, or there are one-off climate events, then we'll probably have to see the kind of impact that they will exert on this food inflation trajectory, and in turn, the headline inflation for the next fiscal year. So as of now, I think we are pretty much on trajectory to achieve the 4.7% for FY25 for the headline average CPI inflation. For next year, we are building or we are working with a base case where we would see 50 basis points of correction from 4.7. So next year's number that we are working with is close to about 4.3. And that is largely premised on food inflation comfort continuing well into the next year, and no surprises on crude. And thankfully, so far, the global uncertainties, especially on the trade and the tariffs front, have helped us in a way that crude prices have remained somewhat benign. That works in our favor, though the uncertainty does entail a lot of known unknowns that we'll have to wait and see how they will pan out and impact the economy.
All right, thanks a lot for those insights, Yuvika, and thank you once again for taking time out to join us. Industrial production as well as CPI inflation figures both looking good and both giving us positive surprises today, so that does sort of bode well even for the outlook going forward. Sanjana, over to you.
Absolutely, Pallavi. Reassuring as this is an edge-of-the-seat thriller that I think all of us kind of experience every time we know that the data is going to be out. But thank you so much for those updates, and thanks to Yuvika as well for that insight. And on to a story now that we've been tracking very closely. IndusInd's stock rebounded today, rising over 5% and snapping a 5-day losing streak. Now, this recovery was partly due to positive statements from the bank's management that the bank would remain profitable despite the one-time loss. Now, just yesterday, we saw IndusInd Bank shares experiencing a significant drop of almost 27%, marking their biggest single-day fall on record. And amid all of these issues, NDTV Profit has been inviting the management of IndusInd Bank time and again to come on the channel and answer questions posed by shareholders. But the management is reluctant. So as we scratch the surface of the accounting discrepancy, we found out that CEO Sumant Katpalia and Deputy CEO both had sold 80% of their shareholding in the bank during its peak. Understandably, this raises some more pretty grave questions about what the management knew beforehand, what they did not to disclose to shareholders. Let me quickly go across to my colleague Harsh now, who took a look at the claims made by the management of IndusInd Bank in the previous quarters. And Harsh, just take us through. What have you found so far?
Well, yes, whether we can actually trust the bank's management and their commentary is what I've tried to kind of break down. And what I've also tried to do is that the stock has fallen quite sharply from the highs, but on what are the key reasons for each of the stock falls, and there are 3 to 4 of them. So first off, 30% stock fall between mid-September to around late October 2024. This was on the back of asset quality issues. That's point number 1. At the end of Q1, largely these asset quality issues were not visible, nor was there commentary coming through. There was no indication whatsoever given in the Q1 con call, nor was there any indication of this even in the pre-earnings release in Q2 that comes just about 15 days prior to the actual result. Nothing disclosed, just the growth numbers, a rosy picture. And therefore, begs the question as to whether commentary that's coming through is even reliable enough or not. And therefore, what I've tried to now do is break each of those. In terms of Q1, what was said, there'll be an improved growth trajectory in coming quarters is what they're saying. Second, in Q1, they said that growth slowdown was due to external disruptions. And third piece was that stress observed in credit cards. No mention of microfinance stress, no mention of the fact that growth is slowing down because there is likely stress in microfinance. No early indications coming through. Either the internal processes of the bank are questionable, or were the CEO as well as the management aware of it and didn't disclose it, is the real question. Growth slowdown as well, nothing indicated. In Q2, cautiously optimistic about growth in MFI and vehicle. Growth in Q2 hadn't come in MFI and vehicle. Improved performance expected in the second half of this year. Mind you, provisions have remained elevated in Q3. So really this hasn't really translated at all. And there was a contingent provisioning of 525 crore to fortify the balance sheet, which was supposed to be sufficient. But still, provisioning continues to be elevated in Q3 and continues to be expected to be elevated even in Q4. What was told is return on assets will normalize going forward. The Q3 ROAs were at 1%. Likely Q4, you're not even going to see a 1% ROA. There's no improvement in return on assets in Q3. That's where I'll start off the Q3 commentary with. Higher gross slippages from microfinance have come through in Q3, which was not indicated in Q2. Slippages expected to be elevated in Q4 is now what they've guided for. So all of this has led to a further 11% decline in the stock price in January as well. So January of 2025, we saw another 11% decline. Now comes to the main crux of the matter with regard to the truncated extension of MD CEO as well as the derivative segment issues. This led to a 14% fall in March of 2024 largely, 12% last week alone, likely penciling in that the street had already got wind of the fact that the RBI is only going to give a truncated extension to the CEO and Managing Director, Mr. Sumant Katpalia. Now, with the derivative loss, and mind you, these losses were known in October of 2024, on the same day that the con call for Q2 happened. No indications in the Q2 con call, no indications in the Q3 con call. Now they are coming out and saying we didn't indicate it because we didn't have a number. And after this number has come out of 1500 crore after tax impact, the stock has taken a nosedive, 27% lower. Look at the 1 month returns, year-to-date returns, 6-month returns, and from the 52-week high, it's down 60%. Who has suffered here? Not the bank's management. It is actually the shareholder. And it's because of poor disclosures by the management time and again on various issues, growth, asset quality, and the derivative loss.
Harsh, thank you so much for taking us through that insight on what happened at IndusInd. The management there has some tough questions to answer by the shareholders, of course. This is on everybody's mind. But you mentioned something very crucial. You spoke about the CEO and the deputy CEO selling 80% of their shareholding during the peak. Now, these shares are sold just 3 months prior to the stock collapsing. Give us all of the details on that.
Absolutely. So it's fascinating here that when you're seeing the way in which the stock price has nosedived, 60% from the 52-week high, but you have the management selling at the 52-week high. You had the MD CEO who has literally sold shares 3 months prior to the stock collapsing 30%. And therefore, and I'll also give you and paint the picture with the amount of the gains that were made by the MD CEO. 80% shareholding by CEO and Deputy CEO was sold in June of 2024. This is prior to the first quarter results coming out. The IndusInd Bank stock fell 30% between mid-September and maybe mid to late October 2024. And this was already when the derivative segment loss ought to have been disclosed but wasn't disclosed. And yet the stock has fallen 30% purely on the basis of asset quality. Now, I'll quickly talk about what the CEO has done. ESOPs of nearly 2 lakh shares were picked up at 519 rupees a piece, costing him around 10 crore rupees. He has sold these ESOPs on the market in June of 2024. 2 lakh, nearly 1.9 lakh shares of this 1.98 lakh sold at 1,524 rupees, a 1,000 rupee gain on each share, and netting a cool 28 crore rupees from this transaction, grossing a 28 crore rupee from this transaction, netting an 18 crore gain from this transaction. And his CTC, as per FY24 annual report, is just 7.5 crore. He's netted 18 crore just from the single transaction. 1524, 1560 roughly is that 52-week high on the IndusInd Bank stock. So really selling nearly at the 52-week high and netting 2.5 times his annual CTC just from that single transaction. And this is 80% of his ESOP holding. Why has he done this? Well, nobody's really questioned him, and he's not come on our channel, and therefore we haven't been able to do that either. 52-week high was 1,567 rupees per share, and that happened in April of 2024. He's literally sold in June. He currently holds 48,000 shares in IndusInd Bank. This was as on the date, June of 2024. So he could have sold this as well. Well, grateful that he's not done so. Quickly moving on, you have Arun Khurana, very similar. He's grossed a 32 crore number. And this kind of just goes on to show that the management has been enriched, but really the shareholders are the ones which have really taken the hit of all of this.
Absolutely, Harsh, and like we rightly said, a lot of questions now emerging, and hopefully some that the management will actually come out and answer. But that's all the time that we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV.
Hello and welcome to NDTV Profit. Blackstone is completing 20 years in India, and with me today is Steve Swarzman, co-founder, chairman and CEO of Blackstone Group. Steve, thank you very much for joining us on NDTV Profit. It's been 20 years in India and Blackstone has completed 40 years globally as well. How has been the journey in India for you?
The journey in India has been fascinating, actually. When we decided to come here, the first time in 2005, we announced that we were going to be having an objective to invest $1 billion in India. And at that time, that was a huge amount of money. And we ended up being on the front page of every newspaper in the country, on television. It was very unusual and unexpected for us. And now, of course, we've grown massively here in India, one of the top 10 business houses in the country. We've aspirations to be much bigger over the next 5 to 10 years. We've learned how to work in India. It's not like everywhere else, and we actually didn't have great success our first few years. And what we realized was that we weren't doing what we used to do. What we do almost everywhere else in the world is when we're buying companies, we buy the whole company. So sometimes the people who sell it to us keep some of it. And then we decide, how can we make this business grow better? Because Blackstone are business builders. We started out buying minority interests, which is what people were doing at that time. And what we found out is that that was a frustrating strategy for us. and it didn't always have a good outcome. And so we changed what we were doing. And we went back to our roots around the world. And we said, okay, India is different in a lot of ways, but controlling and managing a business is pretty much similar around the world. And once we made that change, we've done amazingly well. And our results in India are our best any place in the world. And we've grown to be the largest foreign company in India, the largest owner of real estate in the country, the largest leverage buyout firm, private equity firm, you call them now, in the country. And it's been a remarkable experience. And you don't do that without having amazing people working in India. And what we've learned is that the talent pool here of extraordinary people is very high. So we feel very lucky to have been here. We were here really early. I always thought India would be an interesting place. When I grew up, my father had been in India for World War II. He was in Calcutta and for the U.S. Army. And I had a little jar of carved ivory that he brought home with pictures of elephants on it. So I grew up looking at that every day. And so I always wondered, what it would be like. So I had this very positive feeling about India just from childhood. And it's turned out to be an absolutely wonderful experience for us at Blackstone. And we're going to be bringing more of our business areas here.
And I would like to speak to you about that because you've been able to adapt to the Indian conditions, grow your portfolio in India to $50 billion. Globally, you have an asset base of $1.1 trillion. And when I say that in 20 years, you've been able to grow it from $1 billion, which you first envisaged, to $50 billion now, what is new that Blackstone is going to bring to India with respect to the kind of investments, thematics, sectors? What is new, which is going to come in the next 20 years, maybe?
No, things will happen faster than 20. We continue building great companies here that we acquire and continue building our real estate. We will probably be bringing at some point our credit business. Around the world, we've extended about $450 billion of credit, and we have nothing here in India. And the India economy is quite vital, and so it's logical that we should want to do that. Another area that's interesting in India is infrastructure. We have a marvelous infrastructure firm, within Blackstone. And so this is another logical area that we can look at. A third one is we sell products, investment products around the world to what's called the private wealth area, which is individuals. And we think over time that would be a wonderful thing to do here. So those are only three things in addition to the two huge areas which people see us now as very substantial and large. But I remember when we had nothing. And so you can build very substantial businesses in a country like India because of the growth, because of the flexibility of the people, because of their intelligence, because the government is improving the ability to do business here. It's never been easy. India is a complex place, which everybody knows, but it's becoming slowly, a little less complicated. So I think the central government here has made a lot of strides under the leadership of Prime Minister Modi.
Steve, over the last 40 years, you began as a property fund and then transitioned yourself into various sectors, which you spoke about as well, that you want to bring to India, which is infra, private credit, in thematics, you have data centers, others. What has been the kind of experience that you have when you moved out and diversified from just being the largest real estate owner to other thematics?
Well, you have to be curious in life, and I've always been interested in when things are changing, and I like to try and figure that out as soon as I can with as little information as I can. So to enable that at Blackstone, what we do is we have all of our business units meeting every Monday. And there are about 6 of us who sit at a big table, and each group comes in. We learn about everything they're doing, in terms of new deals, new investments, problems, or good pieces of luck with our existing investments. And because each one of our groups operates globally, that we learn things by the end of a day, sitting at a table, of how the world is changing. And little pieces of information have enormous power. Most people, when they hear something that is inconsistent with what they have seen or believe, don't have any interest in that piece of information. They just keep doing the same thing. The way we're trained is that little piece of information that's inconsistent is the pathway to change happening. And we just have to figure that out. And as soon as we figure it out, then we say, okay, where else in the world is that same change that other people don't see going to be happening? And then we either buy something there or we sell something because something bad's going to happen. And that exploration is fascinating. And that's what gives us an edge. And once you see that something's happening, you absolutely move to accomplish what that tells you. You don't hesitate. You don't consult 5 other people. You know that that's happening. And that ability, that predisposition to action with paradigm changes is what's enabled us over time, along with great people, to accomplish something that is very rare in the business world.
You've been one of the early movers for strategic shifts, data centers being one of them. What is your view on how data centers business is going? Within Blackstone, you have nearly $80 billion of assets in data centers, and I think, if I'm not wrong, another $100 billion under development. So how do you see the data center business growing, and where do you see India in the whole scheme of things?
Well, the data center industry is going to continue to grow rapidly because artificial intelligence is going to grow rapidly, and you cannot have artificial intelligence without data centers, because that's where the computations and the computer is located. And so if you believe in artificial intelligence, which I do, and so do almost everyone who knows something about it, then data centers will expand in terms of scale. The conventional wisdom is that there'll be $1 trillion more of data centers built in the United States over the next 5 years, and $1 trillion outside the United States. Right now, India is quite small in that regard, probably for a variety of reasons. That will change over time. So these are early days for India. And we have a company here doing that. We bought another company in Australia that's actually much bigger. We've made a commitment here in India to put $11 billion into data centers. This will be a trend that increases over time here. And as I say, it's early days.
No, you mentioned the fact that artificial intelligence will play a big role going forward, and you're very bullish on artificial intelligence. There's a huge debate which is going on the cost of artificial intelligence. Do you think that investments into artificial intelligence will continue? And as cost efficiency brings in more low-cost AI into it, the use of data centers will increase going forward?
Oh, I think that's all true. I think the power of the artificial intelligence movement, if you will, is going to be growing at a very accelerated rate. You're just seeing the beginnings of that. One of the experts told me that, ChatGPT, which was the first artificial intelligence application that the public saw, it was like a very smart person, maybe an IQ of 180 to 200. The experts have told me that 180 to 200 IQ for artificial intelligence is going to end up as 12,000 IQ. If you can imagine dealing with something that has a 12,000 IQ, just let your mind wander as to all the things that can do to help you have a better life and have interesting experiences. It's really stunning to think about that. And that should be happening as soon as we can let the technology develop, which will happen over the next 10 years, and build as many data centers as the system can take, because they consume a lot of electricity. So different countries will start running out of electricity in the developed world. Imagine what all of that can create for the human being. Some amazing stuff, accelerated drug development so people will have, better health, better lives, different ways of developing education, through your smartphone, which will be particularly good for a country like India, where the wealth of the country is besides being uneven, there's only a $3,000 GDP per capita. So there are lots of people who could use enhancements in their life. And the people who are experts in AI believe that they'll be able to deliver for that cohort of people. How wonderful will that be if people's lives can be improved?
If AI is going to have an IQ of 12,000, where does it leave all the tech companies?
Well, where does it leave humans? Where it leaves humans is wanting to have a friend that's AI, that can do things that we can't do. To in a commercial setting, in terms of doing research, that AI will be able to do things that take weeks of work. You can do that in 5 minutes or less. So it will increase the human's ability to accomplish things.
Mm-hmm. You mentioned in one of your answers that the world has changed, and the world is changing now drastically in the last couple of quarters. There is issues of growth, inflation, interest rate, you have tariff, all those coming into play. and that changes the dynamics in which businesses flourish or work. How do you navigate this kind of volatility, given that you have seen the entire cycle of business for the last 40 years?
Well, there are certain things that people get very excited about because they're happening today and they weren't happening 6 months ago. So they think that will be exceptionally disruptive, or, they sometimes get overly worried about certain things that I've seen over time. The system adjusts to those. And we have a number of things going on, as you mentioned, at the moment. So you're seeing securities markets respond to those uncertainties, mostly by going down, but not everywhere. Europe, which was a real laggard economically, is going up. And China, which was very much a laggard, its securities markets are going up. So different parts of the world get affected in different ways. I've found it's important to try and figure out where you think the biggest impact will be. Try and get a sense of how long a period of uncertainty will exist. I don't get excited when things go down when they should. And there are a lot of people who try and change that trend by changing behavior. And so as humans, we tend to think things move in straight lines. And we extrapolate either things that are bad, they're going to be terrible, or things that are really good, they're going to go on forever. I've learned that trees do not grow to the sky, and the world is also not ending. And so figuring out which of those trends are short-term, you can take advantage of that. Most people get so worried they almost panic and they stop doing anything. That's the wrong answer, and so I've seen a lot of cycles, and you usually can tell where you are in that, and you don't buy things right away. You let it get bad, and then when everybody else is sort of really, really worried, that's usually a time when things are going to switch. And that's when we try and invest.
Is this a new normal for the world?
Well, it's a new normal because technology and the use of the internet is taking reactions that never would have happened, and now they become shared by groups. And so that increases volatility because of the instant communication that we have. We used to read newspapers to find out what was going on. It's a huge lag with that. Then we went to television, which has the ability to reach people simultaneously. And now everybody has their own little communications network, and they get things immediately. And that's how Silicon Valley Bank went bankrupt, because somebody said, I think they might go bankrupt. And in a few hours, that was communicated to other people who said, give me my money now. There was nothing wrong with Silicon Valley Bank, which was the second biggest bankruptcy in U.S. history. What was wrong is that everybody could take their money out at the same time. So that kind of almost harmonic move introduces risk and change. So you have to be aware that when certain things happen, sometimes they end up over the short term having a bigger amplification factor. But I'm comfortable with that just because that's the way the world is. So you have to manage, people's money in a way that protects them from that kind of overreaction.
Steve, I'm running out of time, but my final question to you is, as a business leader, how do you navigate, and what is the kind of message that you have for the business, small businesses and big emerging businesses in India to navigate this volatility?
Well, I think with India, because there isn't as much of that connectivity as there is in the developed world. That India has some natural protections. They also have quite good regulators who are alert to protect, their society. So if I were a small business person, I would not worry because India has shown that it can grow through virtually every one of the problems that have affected the wider world. And maybe they'll grow a little slower run here. It's not the end. So I think that the prospects for India are very good, despite the fact the stock market's been sloppy here over the near term. It was probably a bit frothy and overvalued before. And India's been around, for thousands and thousands of years. And it's always been a major country. And as a small business person, you have good government. You have a lot of very positive things here. And I'd be happy to be here.
Steve, it was a pleasure talking to you, and congratulations again, 20 years in India and many more to go.
Well, thank you very much.
Thank you.
Very, very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.